Good morning and welcome to part 3 of Real Estate Economics weekly webinar series, this week covering the greater Seattle area. In this section we'd like to address our housing market model. We talked a little bit earlier about employment in this particular area. That drives the demand for housing, which you can see in the oscillating green line in this particular slide. When jobs grow quite quickly, demand takes off. As you can see, different peaks and troughs in demand for housing for this market. At the same time, supply tends to grow quite slowly. As anyone in the business knows, it takes a long time to acquire the land, get the approvals, the financing, put the whole concept in place. So supply tends to grow at a very slow level and is growing at an even slower than historical trend here in 2010 and 2011. During periods when job growth is below trend or substandard for that particular time, then the housing stock is in effect too large for the employment base, and we have weak housing prices. When the employment is strong and the jobs are growing very quickly, then we have house price increases, because the only way for that excess demand, if you will, to manifest itself is through house prices. So prices are oscillating in response to changes in employment. At the same time, supply remains very steady. This tracks into housing valuation. If you can see the blue here, it's the historical for the past and forecast median home price for this particular market area. The green line is what's supportable. Now, what's supportable is calculated on local household incomes and current interest rates. If you can see, more or less, these track together pretty effectively from 1990 all the way up till about 2005, when all of a sudden we enter the subprime period. The home prices become detached from incomes because people can suddenly qualify for much larger loans than their income might support, or their ability to pay back might suggest. Gets us into trouble that we start to see in the 2008 to 2009 time period. The recession during the 2008 causes the median home prices to come down quite dramatically. You can see where the green line crosses over and heads higher. That's when interest rates were cut from 6% to 5%. That significant decrease in rates drastically improves affordability. So now we have the supportable home price line well above the median in the forecast. That's presenting us with a condition of undervaluation on the ground. Just it's not really able to be manifest or taken advantage of because of poor psychology and weak sentiment due to job losses and the recession, that sort of thing. Over time, people will begin to recognize that homes are again a good bargain or a good value, and as the employment picture comes together, that undervaluation will narrow, and again those lines will cross again in the out years in the 2014 time period. Let's look at price trends in this particular market. We had a good move up here in the early 2000s in sync with the whole dot-com. Supply is not that large here, and so there was really no pullback on the price side when we experienced the dot-com bubble burst. Then we increased pretty rapidly through the 05, the 06, and the 07 level, but not nearly as much as many of the Western markets. We got a good move up from 246 in 2003 to about 380 in 2007. That's a big number, admittedly, but not nearly the kind of speculative excesses we saw in the Vegas and Phoenix markets. If you look out over the forecast period, we're saying 326 right now, so we're right about 2005 prices, and over the forecast period we'll come back close to all-time highs. That's really not that evident in most markets we look at. It's going to take years to reach back to those levels in most of the markets we serve. In this particular area, we can see that in a 5-year forecast. Year over year price changes, you can see a consistent history here of double-digit growth. Supply again is not that great, and demand to live in this area is pretty substantial. So values have had a real upward bias, particularly through the 90s and 2000s. We've got a little bit of bubble here, obviously, 04, 05, 06, where we sustained some mid-double-digit, mid-teens there. In 2008, we started to trail off through the 09, and a little bit of downtrend here in 2010, coming back towards long-term trends in 2011 and through the forecast period. Those numbers are again going to be limited by slow household growth and increasing interest rates. For those of you who are familiar with our webinars, this is our opportunity risk report. We publish this for every area in our residential economic report, and this puts together a forecast for 5 years out, conditions on the ground, tying in the factors you can see in the header: housing demand, housing supply. We determine whether the market is overbuilt or underbuilt, and if you recall, that's primarily a function of employment. When the employment market is good, housing becomes underbuilt quite rapidly. When the employment situation deteriorates and we lose a lot of jobs, the market becomes overbuilt almost equally as rapidly. We make a median home price forecast and an appreciation forecast. So if you're looking at some price trending or looking at communities that are going to enter the market in 2012 or 2013, this provides a pretty good, time-tested, economically supported measure of appreciation for this market area and an equilibrium home price. And I think the interesting thing, if you look to the forecast for this equilibrium home price at the center of the stage, we actually have this number coming down a little bit year to year to year. And that's being caused in part by fairly slow household income growth and increasing interest rates over the time period. Again, as we mentioned earlier, putting a little bit of a lid on housing market appreciation here, keeping it 2, 3, 4, 5%, which after the size of the disruption we've experienced, we think are fairly moderate numbers that are awfully close to long-term trends. Over on the right side of the graph, you can see our opinion of whether the market is overvalued and undervalued. Now that's really a function of the relationship between interest rates and household incomes unique to this particular area. So this is really based only on this MSA as to how overvalued or undervalued it is. We can tell that it's undervalued in a couple of other ways. We see a lot of parents providing economic support to their kids buying homes. People who've been through the cycle a couple of times recognize the magnitude of the undervaluation and are helping their kids out. On the far right of the column, we look at market health in 24 months. So that's 2 years down. 2 years out is where we're really talking to here. So if we go to 2008, we can see that the market is underbuilt at that particular time and slightly overvalued with a stable rating on it. If you recall, in section 1 of the presentation, we showed a trough in both sales volume and prices. So there's our sign of stability that we've essentially predicted going back several years. If you look in the out years, we've got a generally stable environment going forward. The market does remain overbuilt for 2010 through 2014, again because the jobs aren't sufficient, and it also tends to remain undervalued. People can still afford more home than the median prices in this particular area, and we're just really being held back by economic conditions and confidence issues. That's part 3 of our weekly webinar series for Seattle. Please listen to part 4 if you want to hear the whole section, and we'll be back and present that in just a moment.